We're at 2 minutes after. So my name is Thomas Opel. I'm the Executive Vice President of the American Sustainable Business Council. One of the hosts for this webinar today. I would like to first acknowledge all of the other sponsors who've joined in this campaign: Social Venture Circle, Trillium Asset Management, Green Retirement, the Interfaith Center for Corporate Responsibility, the U.S. Impact Investing Alliance, and the Green Business Network, in no particular order of importance. All equally great partners on this campaign regarding a new proposal from the Department of Labor, which would restrict ESG funds on ERISA regulated retirement plans. And we're very happy you're joining us this afternoon. This is particularly timely because, as we'll discuss, the comment period on this proposal is rapidly coming to an end at the end of this month. And we hope that if you haven't already taken action, this webinar will encourage you to do so. We're going to be hearing today from three experts in this area, and I'll be doing a presentation as well. First speaker will be Timothy Yee, the Chief Retirement Specialist and co-founder of Green Retirement. Seda Geis is the Investment Manager for Trillium Asset Management. John Cochran is the Manager of Policy and Programs for the U.S. Impact Investing Alliance. And they will be talking to you about the aspects of this proposal. Before we get to Timothy, let me just do a quick commercial, if I might, for the American Sustainable Business Council. If I can get my screen to work. We are a network of approximately 250,000 businesses composed of members of the American Sustainable, companies who are members of the American Sustainable Business Council, as well as organizations that are members. And we are actively engaged in policy arena impacting sustainability and what we like to call the triple P, people, planet, profits. So we have active campaigns going not only in the area of this particular proposal, but across the board in terms of high road economics, advocating on behalf of paid leave, advocating on behalf of raising the minimum wage, advocating on behalf of steps to mitigate against climate change. We have active working groups on climate and energy, as well as sustainable packaging. We're also working on infrastructure, attempting to get infrastructure bills passed at the federal level. And we work at both the federal and state levels. So with that out of the way, let me move on to our first speaker, Timothy Yee with Green Retirement. Timothy?
Thank you very much. Appreciate it. Thank you. Again, I'm Timothy Yee with Green Retirement. My back office is IFG, based in San Diego. And hopefully everyone can hear me as my screen just vanished. Oh, there we go. Perfect. And Green Retirement and IFG are separate companies, not FDIC insured, FINRA, SIPC. Past performance is no guarantee of future results. But having said all that, I thought we would dive right in. I included in the chat link for everyone to see the actual Department of Labor ruling. Came out late June 23rd, as I recall. And I spent the following Wednesday reading all 63 pages of rather tedious stuff, but also very infuriating. The 401k space, folks, is about $7.8 trillion as of March 2018. So $7.8 trillion. This ruling focuses on environmental, social, governance investing, or ESG, and ESG investing is approximately 0.1%. 0.1% of this total. Now, certainly there is growing demand from the defined contribution plan sponsors and participants for ESG. Matter of fact, again, turning to 2018, if you look at the total amount in ESG, you would find it was around 12 trillion. So $12 trillion in ESG, with one in every $4 being invested with a financial professional going into ESG funds. So clearly, there is a demand in the defined contribution space, as well as the general public arena, $1 in $4 going into ESG. At Green Retirement, we advise 90+ retirement plans all across the United States, up and down the East and West Coast. In a normal year, I would be on the road 4 to 6 months out of the year meeting with clients. All of these plans are at least 50% socially responsible, and no less than 10 are completely fossil fuel free. But still, folks, the total amount in ESG out of the 7.8 trillion in the 401k space, the total amount is 0.1%. So why is the Department of Labor looking into something like this? Why is the focus here? It makes me almost wonder, what is the agenda? And to answer that question, I go back to when my kid was little. He always told me, "Dad, follow the money." So what we see recently is the Department of Labor is allowing private equity funds to get into the 401k space. Yes, 401k investments can include private equity, which typically is for accredited investors only. Talk about a complex product. And annuities. Annuities are starting to get into the 401k space. So why do those particular investments get a pass when they have higher fees, and frankly, they don't get any scrutiny? And it takes quite a bit of understanding to actually flesh out what those products are. Why is there such a focus on ESG? Well, again, I took a look at the actual regulation.gov website where this particular bill is filed, and lo and behold, it's classified under energy. It's not classified under Department of Labor. It's not classified under 401k regulations. It is classified under energy. Now, that could be a mistake. I'll grant that. But I wonder, might this proposed ruling, which seems to want to get plans to avoid ESG and stay in traditional investments, might it have something to do, folks, with the $14 trillion pledged for divestment from fossil fuels? If you take one step backwards to April of last year, you notice the administration asked the Department of Labor to find out how much retirement plans were investing in coal, natural gas, and oil. Maybe it's just me, but does anyone else see a trend here? Well, against that background, I will offer 4 thoughts. ESG is a necessary analytical tool. It can help identify relevant portfolio risks. As a philosophy, it can result in better returns, as shown by numerous white papers. Now, I already said past performance is no guarantee of future results. It would be foolish in our industry to try to predict the future. At the same time, could it be argued that ESG, with its focus on E for environmental, might have been able to steer investments clear of fossil fuels? Maybe, possibly. What do you think, folks? I won't mention any specific investments here for compliance reasons, but again, I think the white papers do a very good job. Point number 2, I pondered about the mission-driven companies, whether it's B corporations, benefit corporations, or even some of the religious organizations where their mission or their values are part of the DNA. As one of my sponsors said, this is who we are. Now, last Thursday, I held a webinar for my clients on this very topic. We had 26 engaged plan sponsors, and our clients are leaders in the ESG space. Certainly, offering ESG investments is a way to attract talent, but it's also a way to express who you are. And I did find myself wondering in that meeting whether or not we might see pushbacks to this proposed ruling from religious organizations. Imagine members of a certain faith being told they have to invest their retirement plan in ways contrary to what they believe. Now, one of the issues that the Department of Labor raises in the 63 pages is that there is no pure definition of ESG. Now, no pure definition. I'd say that's a valid point, but it's because there are many different ways to measure the different factors of ESG. For example, your investment might focus on gender equality or no fossil fuel holdings. One investment company I know states that its definition of ESG is to have no tobacco holdings. Well, that certainly is a definition. Another focuses entirely on sustainability. So maybe this would actually result in a tighter definition of ESG. I guess at the end of 63 pages, that was about the only exciting thing that I had to say. Maybe we might get a tighter definition of ESG. You know, one of the things that really bothered me, though, this administration has frequently talked about small government and being pro-market capitalism, yet this particular ruling, by saying a plan cannot invest in ESG, this particular ruling is anti-free trade. So again, folks, I have to ask you, why is this rule being offered? It definitely is a head scratcher. We will talk about resources and what you can do. But for now, I'd like to turn it over to Sada. Sada is with Trillium, and Trillium is one of our retirement plan clients. And Sada, maybe you can speak to an asset manager's point of view.
Thanks, Timothy. Appreciate your comments and agree fully. So for those that might not be familiar with Trillium as a firm, Trillium manages over $3 billion in assets, primarily in public equity and fixed incomes. We do have mutual funds, which would be available in 401k plans with a long history of investing with environmental, social, and governance considerations really integrated into our investment process. It's how we've done things since 1982. It's how things have been done in our global equity strategy that became a part of Trillium a few years back, that has a 20-year history of managing a global equity fund without investing in fossil fuels. And I think Timothy points to a lot of key problems with how we're thinking about, or at least the DOL is thinking about, ESG and how it is feeding into the investment process for asset managers. They're really selling it, although it depends on what page of the document you're looking at, as this idea of something that's pretty arbitrary and not tied to the performance of the portfolio. That is not how we see the world, and increasingly it's not how many investment managers and asset managers are seeing the world, right? Thinking about good environmental practices, thinking about strong social platform profiles, companies that are well managing their human capital, and companies that have strong governance structures are absolutely attributes of a company that is positioned to perform, right? We believe that is these are important aspects as we're evaluating companies from a risk perspective as well as an opportunity perspective. This is not a out on the edge position, right? You're seeing the larger groups like the Chartered Financial Analysts Institute, CFA Institute, which is really kind of the gold standard, right, for folks in our world from a certification perspective, talking about ESG integration. You're hearing the largest asset managers in the world, the BlackRocks of the world, Wellington, that are talking about carbon risk being an important part of how they're looking at their constructing portfolios. I mean, if we think about it in just a common sense way, if you were an insurance company that wasn't thinking about how climate change is going to impact your portfolio assets, if you were an energy company that isn't really thinking hard about stranded assets and what your portfolio looks like 20 years from now in a carbon constrained world, you are poorly managing and not meeting your fiduciary responsibility as far as I'm concerned as a company. And that's not a company we want to invest in, right? So the DOL is using a lot of dancing around why they're specifically targeting ESG funds. And Timothy kind of pointed to some of the reasons that might be pushing behind that. I have some concerns about what this kind of a regulation does, right? So first, I don't know that it changes how managers are managing portfolios, right? It's a little bit late to be putting on the lid on acknowledging that climate change and carbon constrained economy are going to be impacting companies in specific parts of the market, right? Analysts are going to be looking at those data points and thinking about them in their materiality. What might change, however, is how they talk about that, how they label the strategies that they're investing in, right? So do you start getting asset managers bringing back the language and not labeling strategies as ESG strategies, but rather doing it in the background? I've seen this happen, right? When you go and talk to a portfolio management team and you say, I noticed you don't have any energy or utility stocks. and they give you a real logical framework around the investment thesis behind it. And we say, well, why aren't you an ESG fund? And they say, well, we don't want to be boxed into ESG funds, right? So if the problem that the DOL is trying to address is confusion in the marketplace, I agree with Timothy. There is a broad definition of what ESG means. But by telling plan sponsors that they are going to have an additional burden and risk if they are adding ESG funds to their portfolios, you're actually going to have the opposite effect of removing that language from funds and companies being deterred from being very forthright in stating what their objectives are and how they are integrating these risk and optimization on the return factors. I think that they're similar to some other kind of new guidance that we've been getting from the DOL on proxy voting. Commissioner Lee put it well when she said this was, that guidance was unwarranted, unworkable, and unwanted. I think this is meeting the same, kind of criteria where as an industry, we've been working hard on definitions. I think we acknowledge that there's a lot of definitions for what SRI, ESG impact are, but calling out the space and putting a huge administrative burden on plan sponsors if they want to include these types of strategies that plan participants are asking for is not going to do anything to really address the underlying concerns around confusion. It will only make it worse. I'm going to leave it there and hand it, I think, am I going back to you or to John? I apologize. Back to you.
Me. Thank you, Seda. We appreciate it. I as the Executive VP of the American Sustainable Business Council, I am not constrained by some of the regulations that folks who actually manage money and are expert in this area are. So I can say, I think if you look at the history of this administration over the last 3 years, it is clear that there is the old argument of free markets that you don't pick winners and losers has clearly been abandoned by this administration. They clearly intend to pick winners and losers. And despite the fact that the world is changing, they seem to be intent on picking the winners from the 20th century, maybe even the 19th century, and not focused on the fact that the real winners will be the innovations and the technologies and the advances that are being made in the energy area, as well as a whole lot of other spaces for the 21st century. And so it's pretty clear the direction that this DOL proposed regulation is yet another step in that march. So I will say my focus would be to let you know that there are really at least 4 or 5 areas that this proposal and this effort are contestable. The first and most immediate, most urgent is the public comment period. We have some documents in the chat that direct you to language, possible language that you might use if you wish to send your own letter. There is a link from ASBC that will take you to a letter that we have crafted, which you are free to sign on to, add to, whatever. But that period ends July 30th. And so the comment period ends July 30th. So we truly are up against it in terms of the comment period. We haven't discussed this. I'm sure we will in the Q&A, and John may touch on this as well, but there's also a legal aspect to this. Courts have ruled that other Trump administration regulatory actions haven't been as thought out as they should be, and fall in the area of arbitrary and not well documented. And I think, as Timothy and Seda have pointed out, I think there's a strong argument to be made there. Beyond that, once the comment period is over, and perhaps there may be legal action as well, but there's also political action. The Senate Committee on Health, Education, Labor, and Pensions has oversight over DOL and over these issues. And I think Both the chairman, the current chairman is retiring, Senator Lamar Alexander from Tennessee. The ranking member is Senator Patty Murray from Washington. I think both of them, as well as many of the members on that committee on both sides of the aisle, would be receptive to the arguments that this just doesn't make any sense. It just doesn't make any financial sense, doesn't make any regulatory sense, and it is clearly a backwards look, and does not appropriately, to borrow Sada's language, I think it does not appropriately calculate risk and the risks that are coming. I'll also point out that there is a subcommittee for that committee on retirement health or retirement security. It's primary health and retirement security is the full name. Mike Enzi of Wyoming is the chairman of that committee. Bernie Sanders of Vermont is the ranking member on that committee. And again, I think both of those members, obviously from way different political perspectives, but I think both of those members would be receptive to the argument that this really is an anti-competitive, anti-free market proposal. And the last two things, and the last of these is related to this next one. In November, there's an election. And no matter how you're going to vote, I hope you're all registered, and I hope you all will vote, whether it's in person or by absentee, whatever your personal interests decide, so that whatever the makeup of the Congress in 2021 would be another opportunity to go back. Should this proposal be enacted by DOL, should they go forward, there's an opportunity to overturn it. And with that, I'll turn it over to John Cochran. John?
Thank you. Hello, everyone. My name is John Cochran, and I'm the Manager of Policy and Programs for the U.S. Impact Investing Alliance. I'm really happy to be on the phone today and talking about this issue, so thank you to ASBC for organizing and getting so many folks on the line. The Alliance is a field-building organization that's dedicated to growing and strengthening the impact investing ecosystem here in the United States. And we think about that work by a couple of different ways. First, through public policy to create an enabling environment for impact investing, then working directly with institutional investors to catalyze more assets flowing into this space, and then more broadly building the movement globally around impact. We take an expansive view of what impact investing can mean. So the previous panelists have all talked about how important definitions are in this. When we're talking about impact investing, we're talking about US sources of capital being deployed globally across asset classes. We have an advisory board that ranges from philanthropic investors like Darren Walker, the president of the Ford Foundation, through to aggressively market rate folks. Audrey Choi, the chief sustainability officer of Morgan Stanley, is one example. We have some fund managers as well as high net worth individuals. So I'd say that just to give background on my remarks and why we feel that this rule is so important. And not to repeat what others have said, but just to reiterate, we do feel like this proposal from the Department of Labor is just wildly out of step with where the market is going, with where sound investment practices are headed. And we think ultimately it's going to be harmful to investors, to the very plan participants that the Department of Labor has a nominal responsibility to be protecting, the claims that they're trying to protect with this action. I just wanted to touch on a bit of the bigger picture that we see on this because, and again, we hear some of this as my co-panelists have alluded to the ulterior motives that might be behind this. This is part of a bigger push. And so just last week, we also saw, for example, the SEC finalize new rules around proxy advisors, long sought changes from folks like the US Chamber of Commerce to restrict the ability of investors to get advice on how they vote their proxies. We also see strong noises. In fact, they're alluded to by the Department of Labor that the SEC is looking at more aggressive and we think sort of targeted, detrimental regulation of ESG investments and funds. And that's an active conversation that's been going on for a few years now. We had SEC Commissioner Hester Pierce talking about how ESG was a scarlet letter being applied to companies and really decrying this work is somehow holding back markets. So I just wanted to raise this point that it is critical that we respond vociferously as a field to this specific proposal from DOL. I think there's a lot of expectation that Secretary Scalia is going to push through what he wants to push through. But from the SEC and from other regulatory efforts that we've seen in the last few years, there is an opportunity to improve the proposal and to get meaningful changes if we're successful in raising the alarm. So I want folks to come away with this, hopeful that we can push back on this in meaningful ways. If the proposed rule goes to a final rule, as Thomas said, there are other opportunities, other avenues that are going to be open to us to continue to keep the pressure up. But for the time being, just really hoping everybody on this call today and everyone in your networks can get comments in by that July 30th deadline. I saw this morning there are already 420 comments in. We can't see what has been said so far, but that's indicative of a really strong response and the kind of response that might actually cause the department to give second thought to this proposal. I guess my last point on the broader picture is just how out of step this is with global regulation outside of the United States, the EU, Canada, UK, Australia. We see really proactive efforts underway to help investors meaningfully integrate ESG factors and other sort of sustainability factors into their investment practices, to improve disclosure regimes, to promote harmonization of disclosure regimes. So this just is absolutely a step backwards for the United States. It will turn, we think, our retirement market into a backwater for this kind of activity, this kind of investment. And again, just to underscore the point as many times as we can, that will harm investors, in particular the plan participants. And so eager to do anything and everything we can to push back on it now.
Great. Thanks to everybody. We have a number of questions in the chat. Let me start with the most obvious one, and Timothy, I'll throw it back to you. What is it that folks who are listening can do themselves, and what is it that they can do in their own networks?
Excellent question. The first thing that I'm asking everyone to do is please, please, please bombard the DOL with comments. Thomas will be sending out actual documents so you can see template letters. I've included mine. In my letter, you will actually see at the top the website to submit your comments. I'm trying to make this as easy as possible. Thomas has also given the ASPC standard petition letter that you can use. The folks at As You Sow, who are clients of ours, As You Sow has put together a sample letter. One person also asked about, even though I touched heavily on the environmental side of ESG, how about the governance, the social side? Thomas will be sending out the Senate Democrats letter, which hit very specifically on the racial unrest in the United States and how we need to address that, and that this proposed ruling is a step back. So bottom line is for all plan sponsors and interested parties to please submit a comment. Those of you with retirement plans, I would actually beg, plead for you to go a step further and ask your employees to join in. I love it that we have over 400 comments. I would love to see us over 1,000 comments because the Department of Labor has to read and respond to each of those. And just to throw a little bit of a timeline in, if the ruling goes through, I hope it won't, but if it does, 60 days has to pass for implementation and I guess towing the line. The longer we delay this, the closer we get to the elections. So, well, maybe 60 days would happen to be after the elections. Maybe there would be a change in administration. I'm going to go back to rubbing my crystal ball and return it to you, Thomas.
I'm gonna respond. We had a question about the name of the committee that I cited. It's the Senate Health, Education, and Labor Committee. And Lamar Alexander of Tennessee is the chair of that Senate committee, and Patty Murray is the ranking member. If you just Google Senate Labor Committee, it will come up, and you can look at all of the members. But I would say whether you have one of your state's senators on that committee or not, I would encourage you to write to both of your senators and to the members of that committee, particularly if, like most of us, you have a 401k or you have investments and you are concerned about this issue. Simply from the standpoint of competition and the free market. So whether one of your senators serves on that committee or not, fire away anyway. They theoretically are supposed to represent all of us. I think I saw another question, and I think maybe this got answered, but there was a question about looking for a clear and simple way for plan participants, climate activists, and divestment advocates to comment on the rule. If that vehicle can call out racial justice and the fact that it plays into both the G and the S, all the better. How quickly can we get something up that we can send out to our lists? John, you want to take a shot at answering that?
Sure. So it's more of those ready to go resources to respond. I'm trying to find the question in the chat.
Huh.
Yeah, I think we're going to share, as Timothy said, some of the sample materials already put together, including the Social Labs page that ASBC has put together that really automates the process for you. In terms of being able to layer in racial justice, I think it's a really important point, and I think the Senate Democrats' letter does a good job of articulating that. At the Alliance, we're really honing in on the really deliberate sort of overlooking of financial materiality of these types of issues that the department is expressing through this rule. And so to tie it back to a sort of tactical point, one thing that we've been encouraged to do and are encouraging others to do is to just share as much data as we can that shows that these factors are increasingly being understood to be material, financially material to investment performance. And to the point about burying the department in letters that they have to read, to the extent that those letters have footnotes that link to reports, they also have to, in theory, read the report and respond to the data contained therein, and actually be able to justify why they heard that comment, they saw that data, and chose to push forward anyway. So I'll have to look. I think we do actually have some good, and I know just one to throw off on the racial justice side quickly. The W.K. Kellogg Foundation put out a report a few years back on the business case for racial equity, which I thought did a really good job of articulating the impacts on company performance that these issues have. And I think they even go state by state and talk about some of the economic losses created by racial inequality. And I'm sure there are other great resources out there that we can put together and share with the group quickly here.
As we, I was just going to say, John, as we get these resources, what we'll try to do is for everyone who is registered for this webinar, we will forward those out. I think it may make sense for us as well at ASBC on our website, asbcouncil.org. We'll put up a page listing as many of these resources as we can find, and as people suggest new ones, we'll add those as well. We have another question that says the discussion seems to gravitate toward investments in public markets, stocks, fixed incomes. What about private markets? Does the proposal affect private markets equally? Who wants to take a shot at answering that?
I can say it hasn't yet, Thomas, but if we had a second go around of this administration, I can't help but wonder. Perhaps I show my age, but I was, I don't know, I had wine coolers stuck in my head this weekend as it was quite hot out and got me thinking back to years gone by, what happened to Bartles and James. So I had to look it up. And sure enough, I found the excise tax that hit wine coolers, and that's what drove them out of business. And I wonder, only I can manage to connect wine coolers and 401k plans and private equity markets, but are there levers that a second administration of this caliber could pull? Maybe not to drive somebody out of business, but to sway investments towards something else. Could there be incentives given to doing certain kinds of private equity investing? And correspondingly, if you're shifting money one way, well, you're not shifting it another. It's very disingenuous what's happening here, and it's very anti-free market, to your point. And they seem to be taking particular aim at certain asset manager companies, in my limited view.
I would also just add that, you know, DOL guidance doesn't specifically impact folks that are fiduciaries for other types of pools of assets like public foundations and endowments, but it certainly gets on their radar, right? So if you're seeing a TAC and saying that it's not within your fiduciary bounds in retirement plans to do X, all of us that sit in seats as fiduciaries in other pools of assets are certainly looking at that and thinking about it in the context of the work that we're doing. So whereas, you know, and Timothy, you can speak to this more than I do, Ken, but private equity is a de minimis part of our 401k plans, right? The vast majority of 401k plans are going to be in public markets. But there are other places where private investments are being made in a significant size that could be just, you know, as you're getting an investment committee together to make decisions, have some pause if they're seeing attacks on this style of investing in the retirement space.
Well, go ahead.
Please, Thomas.
Well, I was just going to say, from a very conservative viewpoint, the concern is always that once the government has established a right to tell you you cannot do something, then by inference, they may also have established the right to tell you that you must do something. And so there's always that concern. You know, this is clearly in seeking to restrict one kind of investment, one kind of fund. You know, it's clearly picking winners and losers, clearly anti-competitive, and opens the door, Timothy, as I think you said, you know, in a second Trump administration, what else might this administration seek to regulate, either by saying you cannot or you must? But Timothy, go ahead.
Thomas, you know, when we go back to ERISA, which is the guiding light for defined contribution plans, really there are only three things that are being said. I mean, it is a lengthy thing, but three that I would focus on. The first is ERISA does not require you to have the lowest fee or the best performing investment. Frankly, that would be impossible. Your investment committee meetings would be meeting every single quarter and constantly changing the investments, which that would in itself create confusion. What ERISA does ask is that you have a defendable, repeatable process for evaluating the investments. And your advisor should have that and should be meeting with you and updating you on what the defendable, repeatable process is. It should be based in modern portfolio theory, and all mutual funds, all ETFs, everything inside the plan should be evaluated according to the same criteria. And the third thing, which is as close as ERISA gets to talking about investments, they ask that you have a minimum of 3 investments that have different return and risk characteristics. The courts have interpreted that to loosely mean a stock, a bond, or a balance fund. In years gone by, I remember seeing something that said it was a stock, a bond, and a money market fund. So 3 funds, different returns, different risk characteristics. That's as far as it got. And ERISA acknowledges that it's the plan sponsor and advisor's duty to actually pick the investments. your point, Thomas, this is very much anti-capitalism, anti-free market, and it's trying to drive an agenda that, well, as we saw from Royal Dutch Shell and British Petroleum, perhaps that industry might, maybe, possibly not be doing so well.
Well, I know I had the honor of serving in the Department of the Navy for 8 years in the previous administration. And one of the more interesting conversations that I had was with the CEO of Huntington Ingalls, the shipbuilder. In fact, Huntington was spun off from a larger company that was not a shipbuilder. And building ships is kind of a unique business to be in. And the CEO was talking about the difficulty of going up to Wall Street and having conversations with investors and financial reporters, et cetera, and trying to explain to them that the time frame for Huntington could not be the next quarter or even the next year. That Huntington is the only company that builds aircraft carriers for the U.S. Navy, and it builds half of all of the nuclear submarines for the U.S. Navy. And building a carrier takes 5 or 6 years. And the company that owned Huntington prior to Huntington being spun off wasn't used to a margin of only, say, 6 or 7 or 8%. But when you're talking about a $14 billion aircraft carrier, 6 or 7 or 8% doesn't seem so bad. So he was focused on trying to change that time frame. That's another area where, again, if you're gonna sort of force investing decisions into this short-term thinking, we're going to wind up with a lot of consequences that we don't expect. Let me read, this is more of a statement than a question, but let me get the panel's reaction to it. The elephant in the room are the plan participants. Many do not know what is in their 401k plan, including expenses and return ratios. Recent court cases, including the Supreme Court's decision to overturn the Ninth Circuit ruling in Tibble versus Edison, could give the participants ammo to push for more ESG investments in their 401k if they feel that these investments are lower in cost and have a demonstrated return that is higher than non-ESG investments. Now, we've had some conversation about why that may not be the case, but anybody care to react to that comment?
Yeah, I'm happy to jump in on that, Thomas, sort of from 2 points of view. There are any number of investments out there that over the long term have done well. And again, I'm happy to have a private conversation because for compliance reasons, I can't discuss investments publicly. However, there are any number of ESG investments that have done well. Beyond that, I saw an interesting article as I was reviewing for this meeting. It cited over 2,200 white papers that also show ESG funds outperforming. So I think there definitely is a case to be made for it in plan participants. An article I was reading from Investment News that showed younger employees asking for these types of investments. Well, I'm 52, the gray hair is starting to show, so I definitely would encourage them to get involved. One of the other questions, though, that was raised was about the investments. I had said defendable and repeatable process. And Stefan, thank you very much for the question. He was concerned that in some retirement plans, the investment advisor might be pushing certain kinds of investments that are not necessarily in the interests of the plan participant. What I would say to that and to the audience as a whole is your advisor needs to be a 321 fiduciary or a 338 fiduciary. So those two say that they are agnostic as to which investments are being used. They are on the same side of the fence. Now, anticipating the next question, somebody might say, well, even if the advisor is a 321 or a 338 fiduciary, might they still try to push something? Well, Yeah, I suppose a bad advisor might try to do something like that, but you really do need to know your advisor and make sure that the investments reflect what the participants want. If you notice that the advisor works at company ABC and all of the investments in the plan are from the ABC company, that might be an issue. You might give your head a little scratch on that. And then to Stefan's final question about technology, yes, there's plenty of technology for evaluating the investments. Two that come to mind, FI 360, and another one is called FIRM. They all use modern portfolio theory, seamlessly evaluate the investments, and put out a very user-friendly layman report that the investment committee can digest. It's what I use in my practice. Again, we have 90 plans across the United States. I'm very familiar with this. Back to you, Tom.
And Timothy, a fan points out that we're drinking hard seltzers now, not wine coolers. So.
Yes, Megan, you're quite right. And that's because of that excise tax that went from 7 cents to $1.17. It drove my beloved Bartles and James out the door.
If I could jump in, I wanted to, in response to that comment that you read, Thomas, we've spared listeners a lot of the gory details about the technical language of the rule. The one specific piece that really sticks out to us, and I think lays bare the actual objectives of this, is what we read to be a real prohibition of including ESG funds as part of the qualified default investment alternative. And here, this is something that we've been thinking about at the Alliance, of just how important sort of the initial allocation is for determining investor behavior. And this cuts across retirement plans to really all investor behavior. We see that, like, so many people, the vast majority of people, treat investments as set it and forget it. And so that initial sort of allocation is really critical. And having an outright prohibition, I don't have a statistic at hand of how much of 401k assets sits in the default alternative. Maybe one of the other panelists knows, say someone on the line. But we see prohibiting that as a really direct attack at, you know, one of the most promising avenues that you could use to increase that 0.1% of assets allocated to ESG. And of course, we saw this already sort of signaled by the field assistance bulletin that predated this proposed rule, which similarly attacks that QDIA option. So just wanted to call attention to that specific part of the rule that we're really hoping we can push back on.
Yeah, and I would just give the perspective of, so I'm one of the trustees for our plan as, you know, employees of Trillium, and Timothy brought this up earlier, but, you know, if you are a benefit corporation and you want to have your plan to be values aligned and have a broad suite of options, including your default option be in ESG strategies, this is now prohibiting you as a company that has, you know, very specifically said, right, that's what you want. Your plans, your employees work with you knowing who you are. You're now being told. So in the interest, so as we talked about, you know, telling us what we can and can't do, this is essentially telling us what we have to do with that default investment option.
Right. Do we have any other questions? I think I'm trying to go through the chat and the Q&A to see if I've missed anything. I notice, did we get an answer to this? Is it Emily? Is the CFA Institute involved? They published a position paper less than 2 years ago that states that not considering ESG factors is a violation of fiduciary duty. ESG factors eliminate both material risks as well as opportunities. Said, I see you nodding your head. Are you familiar with that paper?
I am. I have not read the whole paper, but I am familiar with the paper, and it actually, I mean, it's in line with like broader considerations, right? And the work that, you know, sustainable accounting standards are looking to work on, and really an acknowledgement that these are risks that portfolios face. And as I discussed, right, thinking about things like climate change and extreme weather and how that impacts different businesses. I would say that there really has been an evolution on the part of the CFA, the Institute on this issue. You know, it is becoming part of the curriculum and not just a side note chapter, right? That there's a fiduciary responsibility to be considering these because they are material, they are meaningful, and especially and maybe I should have said this earlier, but you know, when we think about the context of our roles as fiduciaries and thinking about plan life, if you are a retirement plan that has participants who are 22 years old, if you are not thinking that these environmental and social considerations are going to be material and meaningful in their investment lifetime in the next 4 decades, right? You're not, you know, properly managing risk. And so I think that's what the CFA paper is getting at, that, you know, if you're a fiduciary and you're managing assets for longer durations than the quarter over quarter short termism that we're focused on, that they have to be considered.
Well, again, I just, not to go back to my my Huntington Naples example, but the Norfolk Naval Base is the largest naval base in the world, and it's about to go underwater because of rising sea levels. If you're not accounting for that, then Huntington would be next, and not sure exactly how you pick up and move a shipyard that builds aircraft carriers. Although perhaps West Virginia is starting to look like great waterfront territory. Is there one place that someone can find the 2200 white papers, re-ESG performance and the market? I didn't realize there were 2200, Craig, but.
I was actually going to ask you, do you know if anyone from Sinclair Investments has joined this call? Because they are the ones who referenced it in their letter. And attendees, please do look in the chat. You will see the rather acerbic, if I might say, response to the DOL from Sinclair Investments. And they do mention the meta study that looked at 2,200 studies. And they reference how many of those studies show ESG outperforming. I'd highly encourage you folks to read that letter. And if you are of an analytical mindset, please adapt it to your own reply. But Thomas, do you know, is anyone from Sinclair on the call who might be able to help with Craig's question?
I'm going to look for someone to raise their hand if Sinclair is on. I have a list of I have a list of participants, but they're all names. And so I don't identify companies. But if someone is on, I would encourage, I'm sorry?
It looks like Craig might have found the link and has been kind enough to share it for everyone to take a peek.
I was just going to say, I would encourage everybody to look through the chat. I think there are some great resources on that chat. And as I say, we'll do our best at ASBC to create a page on our website in the next 24 hours. My digital manager is going to love me for this, to try and find a home for as many resources as possible. We're getting people adding resources by the minute. So please do check this chat. And before we get off, for those of you who are not like me, perhaps the Zoom experts, despite months and months of work on this, I would encourage you to make sure you save the chat before the call ends. That's always my trouble is once the call ends is finding that chat again. So there are some great resources in there. We've got about 5 minutes left till the top of the hour. Let me just go back. We'll do this backwards. John, any last words you'd like to add? John, I think you're on mute. Whoops. Yeah, can't hear you. We'll come back to you, John. Seda? And I can see you're on mute. There you go.
Just final thoughts is, I think I will just reiterate with what Timothy and John have both said around, the critical action at this point, I think, is to flood the comments, push back the time as much as possible, and look out 100 days and really hope that we're in a different regime. But I thank everyone, for participating in this call and looking to amplify the work.
Absolutely. Timothy?
Thank you, Thomas, and appreciate the opportunity to participate. Everyone needs to comment. That's just a given. To Stuart's question about date of enactment, if the period for comment closes on July 30th, then the OMB has 30 days to review. That would push us through August. 60 days beyond that would be right at the beginning of November. So that sort of gives an idea as to timelines. There is no grandfathering proposed. This proposed ruling does have enforcement tied to it, so that makes me nervous. In case you're wondering what is in your retirement plan, please go to fossilfreefunds.org, fossilfreefunds.org. It's a free website. You can enter the investments in your plan into that website. You will see not only fossil fuel holdings, deforestation, gender, military and civilian weapons, all of those things will be shown to you. And then please vote. Really, this is one of the craziest things I have seen. I've been in the industry 30 years, which by some definitions makes me a youngster. But this one's crazy. Thomas?
That's a one of those financial technical terms, right? Crazy. I think I remember that from macro. Anyway, let me again thank all of the participants for listening, and a particular thank you to John and Seda and Timothy for participating as panelists. And also, just again, a thank you to all of the organizations who co-sponsored, co-hosted this event with us. I won't go back through them, but great organizations. And I thank you. And with that, we'll just remind you, get your comments in before the 30th. And thanks very much. Thanks for listening.
Thank you.
Thank you.